So should you fire your financial advisor? Do you know how sneaky the financial advisory AUM fees and mutual fund expense ratios can get? In this video, I'll show you how you can lose 1/4 of your entire net worth by hiring a financial advisor using a case scenario and show you how sneaky these fees can be. I'll also teach you 3 simple lessons which you can learn to avoid this catastrophic mistake. Hi, I'm Dr. Abhishek Gadre. I'm a pulmonary and critical care physician practicing in the US, and welcome to the Money Matters MD Show. So are you a physician? Are you a high-income professional? Or maybe a business owner? Are you planning on hiring a financial advisor? This video is for you. So let's talk about a case scenario. Let's say John is 35 years old and he has saved up around $100,000 and he wants to hire a financial advisor to start investing, and he wants to save about $4,000 a month, which is $48,000 a year, and he wants to save for about 30 years and retire at age 65. Let's assume he gets an average market return of about 7% for his entire investing time horizon for a balanced portfolio of stocks and bonds. The financial advisor typically charges an AUM fee, which is assets under management fee. Now, what does that mean? So John in this case is investing $100,000. The average AUM fee in the US is around 1%, which means John owes around $1,000 a year. If his investments grow to $1 million in 10 years, he'll owe around $10,000 in that scenario. The next fee that John has to pay is a mutual fund expense ratio. This fee goes to the mutual fund management company. Typically, financial advisors like to invest in actively managed mutual funds, which have much higher expense ratios than just your regular index funds. The typical expense ratio on an actively managed mutual fund could be anywhere from 0.5% to 1.5%. Actively managed funds are trying to beat the market, and they employ expensive research to do so. Now let's run the numbers and see how John actually did. Well, John did really well. By age 65, he actually managed to save $4.1 million, no surprise. He's been saving consistently for 30 years. But did you see he actually made $5.6 million in his portfolio, and he paid $1.4 million in fees. So in total, he paid about 25% of his entire net worth in mutual fund expense ratios and financial advisory AUM fees. Now, if you don't believe my numbers, you can just go to nerdwallet.com and they have a free online calculator and you can plug in your own assumptions and run the numbers. Now, I'm going to draw 2 lines on this graph, and you're going to find out that John actually made $4.1 million by age 59 if he chose not to pay any of these fees. If he started investing on his own at age 35, he could have retired 6 years earlier. Or maybe he could have given $1.4 million to his kids or grandkids or donated to charity. Hey, so you know this is a perfect example of compound interest working against you. Usually in investing, compound interest works for you, but when it comes to investment fees, like we're paying 1.5% for 30 years in a row, well, guess what? It becomes 25% just because the financial fees also compounding every single year. You're paying 1.5% of your wealth every single year, and it's just working against you. I think it just makes total sense at this point. Now, these are some mind-blowing statistics. So what can you do to avoid these mistakes? Here are 3 simple lessons. Lesson number 1, keep expenses low. Invest in low-cost index funds or ETFs, which are broadly diversified. I'll give you an example. You can invest in a Vanguard Total Stock Market Index Fund. The ticker symbol is VTSAX, and the expense ratio is only 0.0%. If you can keep your average mutual fund expense ratio less than 0.1%, and run the numbers, you will spend less than 2% of your entire net worth on mutual fund expense ratios, which is pretty good. Lesson number 2, diversify broadly. Don't get carried away by recent market performance. And let's say tech stocks have done amazing for the last 15 years. Does not mean that they'll keep doing so well for the next 15 years. Don't try to beat the market, just be the market. Invest in the US, invest internationally, buy some bonds, just spread your love. Don't gamble. Don't take concentrated positions in single stocks. There's extensive research to prove that individual investors can't really beat the market and end up hurting themselves. Rebalance annually and don't get carried away by market going up or down. Just stick to your asset allocation that you decided in the beginning. Lesson number 3, invest your time learning about personal finance. It doesn't take that much and it's very simple and you can do this by yourself. You don't need a financial advisor. All you need to do is spend about 15 minutes a week or 1 hour a month learning about basic personal finance concepts. So I'm going to challenge the audience with a competition. Do you have a financial advisor? Scroll down below and comment what is your current AUM fee and add your current average mutual fund expense ratio and give me the total. The biggest number wins. For more interesting personal finance content, please follow my channel, Money Matters MD, and thank you so much for your time. Over and out. So if you're new to investing and you don't really know where to go and where to get started, I would highly recommend you watch the savings ladder video, which essentially has 10 steps starting from broke and in debt all the way to financially independent. I'll attach the video around here. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice. The opinions and views presented on this channel do not represent my employers or affiliates in any way.